How to invest by thinking outside the box. Free professional Forex trading course video 2. Introduction. In this course I will teach you 5 objectives as well as 3 additional objectives I want to bring your way. I will also teach you how and why you need to think outside the box, as well as the most common mistakes Forex traders tend to make, as well as commitment and temperament needed from a trader to be successful. Let's go over to the market movers in Forex trading. There are 4 main market movers that you will come across that tend to push the market up, down or sideways. Number 1 is corporate earnings. Corporate earnings affect the broader market overall. For example, if you take a company like Zena Mobile, oil and gas, it has an average revenue of about $486 billion per year. Then we have exogenous factors such as war, terrorism, earthquakes, oil and gas prices. If there is war internationally or just within a country, that would have a huge impact on the country's economy or on the world economy, depending on how big the war is. This is factors that have an effect on the markets but doesn't usually can be controlled, like terrorism, earthquakes, which is basically natural disasters, oil and gas prices just crashing down. And then my third point is policies. You get the fiscal policy and the monetary policy. They have huge effects on the currency market overall. And then our last point is report releases. Report releases is released on a daily basis throughout the world by government agencies, private institutions. This covers all phases of the economy, from production, inflation, recession, productivity. It really covers all aspects of an economy, and this has a huge effect on the currency itself, into which way it tends to move. So if you take these 4 points I just stated, which is corporate earning news, exogenous factors, policies, as well as report releases, then you would get a clear picture of, let's say for example, a good idea where the market may tend to go, the trend over a period of time. Then we have the movement of broad market due to macroeconomic events. Let's start in time I remember 2000 to 2003. The market was very negative or bearish, and this was caused by a series of negative waves. This was due to interest rates, oil prices, war, terrorism, elections and uncertainties. Interest rates went up, oil prices crashed, there was war, domestic and international, terrorism cracked out, elections, people was unhappy with the elections that happened at that time, and investors internationally were uncertain about where the international economy is going to go over the next 5 to 10 years. My conclusion is economical forces ultimately determine market direction. This is influenced by war, terrorism, inflation and recessions, etc. Let's go to common mistakes traders tend to make. Number 1, they trade good currencies in a bad market. What I mean by that is, they for example take a country's currency and know this is a good currency to trade, but the market currently is not as good as the currency. So for example, if you take the United States dollar and you know this currency is going to grow over the next 5 to 10 years, but currently the markets of the United States may be in a temporary recession just before there's going to be an incline in the economy as well. So you should be careful to trade a good currency in a bad temporary market, if you can put it better that way. Our second point is bad money management. Failing in cutting losses short. This is a big mistake a lot of traders make. Okay, money management should be perfect. Failing in cutting losses short. Cut your losses short, get out of a losing trade, and let your winners run. That's all I can tell you on that one. Bad risk management. Not diversifying your financial portfolio properly. I want to state on this. Never put all your eggs in one basket. If that basket falls, you break all your eggs. You should diversify your financial portfolio between 5 to 10 currencies at least. Don't just trade one currency, okay? At least 5 to 10. Diversify your financial portfolio. I can't say it enough. This is very important. Then my fourth point is poor trading skills, and my last point is poor trade execution skills. Slip best price entries. For the last 2 points, I can only say get up to date with your technical trading skills as well as your fundamentals. In the fundamental analysis, you will learn about that in this course as you go on further. Commitment and temperament needed to be a successful Forex trader. You should at least devote 5 to 10 hours per week in your investment portfolio. You should be an intelligent speculator in the Forex market, taking calculated risks every time. Don't be a reckless gambler. And that is what we're going to teach you in this course, to be that intelligent speculator and profit constantly in the market. We will teach you not to be a reckless gambler. We're going to teach you a plan, how to follow that plan and get out successful on the other side. Don't just trade for money. You should do this also for the beauty, elegance and satisfaction of the reward thereafter. And then last, just a goodbye note. Thanks a lot for watching my videos in this course. The link to the next video in this course is in the description box of this video, at the bottom or to the right of this video. I really appreciate your support. I hope this will educate you in making smart investment decisions in the future. Please leave comments and subscribe. It would be greatly appreciated.